Welcome back to the fourth quarter update of Pump the Brakes. As I'm recording this, today is November the 5th, and my name's Andre Beckles with Harari Wealth Management. I'm a private, or I'd like to say an independent financial consultant. Welcome back if you're new. Welcome back if you've listened to the channel before. And then secondly, if it is your first time, welcome and thank you for joining me, everyone. Going to be very brief. Want to start off Pump the Brakes this edition with the markets. And you see that I'm not inside the studio, but above it. Hey, there's only a few days left in fall where I figure I can really record outside. So I figure I'd do something a little different. But that being said, markets closing Friday, November the 3rd. Sounds weird saying November, time has flown. But with that being said, if we look at the markets, I'll give you the week and I'll give you the year to date. So S&P 500 last week did better than the CD, up 5.85%. Year to date, up 15%. Dow Jones up 5%. And that was up 4.5% for so far for the year. The NASDAQ up 6.6%, and that is up 29.65% year to date. And the Russell 2000, that is your small size companies, for the week, up 7.56%, year to date, up 1.19%. And if we look at the European markets, looking at the Morgan Stanley EFA, up, or global markets, pardon me, up 5.8% last week, and year to date up 8%. These numbers are brought to you by my team over at LPL Financial. Thank you for them in bringing together those numbers at the end of last week, November the 3rd. So as you can see, year to date, depending on how your portfolio is situated, you may be up in different areas. We have retracted from in certain areas. If we look at the Dow Jones or the Russell 2000, meaning small size companies, we've definitely had a pullback in different areas. So far, if we really look at it, first quarter, second quarter, third quarter, we've had a lot of capitulation. That's just based on uncertainty, where the economy is going, whether there's a recession coming, no recession, high interest rates, so on and so forth. So that's the basics right there. We take a look at the fixed income market. That's the bond market, looking at treasuries. This information is brought to you by Bloomberg. And this is as of also Friday, November the 3rd, the two-year U.S. Treasury was yielding 4.84, 5-year at 4.50, 10-year at 4.57, and the 30-year at 4.77. If we look a little shorter in duration, the Treasury bills, the 3-month was on Friday, November the 3rd, closed at a discount yield of 5.39%. The 6-month 5.46, and the 1 year at 5.27. Last week was a volatile week inside the Treasury market. Just briefly mentioning, we saw rates moving all over the place. Unlike the stock market, you shouldn't see a lot of volatility when it comes to the bond market. It's usually pretty stable and moves in very small increments. But with that being said, last week, I think somewhere around the beginning of last week, we were at maybe about 5% on the 10-year, and we ended at 4.57. So that's a big move. Doesn't sound like it, but it is a big move. So volatile week there. Equities did very well because of reporting of corporate earnings, possibility of no more hikes in interest rates. I'll touch on that in a second. Couple that with the change in interest rates as well. That's why we saw such a good week. I'll throw out a name. Terry from Pennsylvania had mentioned to me, "Hey, should I buy a treasury? The rates are looking good, or should I buy a CD?" Well, CD rates, for some people, you go into the bank, you'll see them around that 4 or 5%. It's interesting. It just really, as I told Terry, it really just depends on what your goal and objectives and also risk tolerance may be. But if you're investing for the long term, if that's a short term strategy for you, so be it. But if you're looking long term, yeah, stocks are very volatile. Yes, you could have made 5% last week if you invested in a certain manner, certain ways. But if you're looking for that steady and less volatile way, maybe the CD is your way. But when I really sit down and consult with people, I really talk about long-term planning versus short-term planning. But with that being said, let me move on. Let's talk about the economy. I touched on the Federal Reserve. As you may know, the Federal Reserve's raised interest rates roughly about 11 times for the year. So right now, if we look at the key indicator, which is the federal funds rate, uh, it's roughly anywhere between 5.25%, 5.5%. So raising interest rates at a quarter of a pop or half of a pop, basically we're virtually down to about zero at one point when we were at the lows of lows, and now we're at between 5.25%, 5.5%. So we've made a lot of moves, and that is considered what's called quantitative tightening, when the Treasury Reserve, Federal Reserve, is no longer uh, buying bonds. When they buy bonds, it puts pressure to bring down interest rates. So when they're not buying bonds, basically it's called quantitative tightening, and that's to tighten the economy when it's overheated. So that's where we are right now. Although the Fed's not raising interest rates based on the last meeting, and I'm going to touch on that in just a second. However, interest rates are at a high. You'll see them whether you're looking at student loans, whether you're looking at mortgages. You hear about the housing market and the tightening there because of the high rates of interest, credit cards, auto loans, anything that where you're borrowing debt. Those rates are definitely up substantially from about a year and a half ago. So that's 2 points I want to touch on with the Federal Reserve. They're leaving rates to sit tight at the moment. We'll see what they do in the next meeting. We look at the job market. The last report came out on the job market actually on 11/3, so that was on Friday. That was brought to you by the Bureau of Labor Statistics. We added in the month of September 150,000 jobs versus the 170 that was predicted by a panel of economists. So the unemployment rate is at 3.9 versus where it was at 3.8 in September. So October rate at 3.9. And maybe some of the, and actually, it would be remiss of me not to mention in September versus we added roughly 297,000 jobs versus the 150 that were created in October. So you do see a slowing down inside the economy. Some of that 150 or why the number may be so low. Yes, the slowing down inside the economy, but also you have a number of strikes that are going on, whether it be in Hollywood, where you have the writers and producers that were on strike. But the big one is really the automotive market. So, and that is coming to a close as we speak. So, the next report will be very important for what we see in the month of November. But that also gave a charge to the equity market, the stock market, seeing that there is a slowdown in the economy. I know it sounds a little weird, but that's how things work. If you don't want the Fed to keep raising interest rates, you do want the Federal Reserve to see that it's slowing down. Next, let's touch on the CPI, which is your consumer price index. And that's really your leading index when we're speaking about what is taking place with inflation. So we look at that rate in September, and that's brought to you by who puts out Bureau of Labor Statistics, pardon me. So the CPI, if we look at it, it's at 3.7%. The Federal Reserve target is 2%, so we're still a ways from that. And that means that I think one of the key things, and I think everybody knows, when you go to the supermarket, you still see prices going up in certain areas, maybe in certain different products that you're purchasing, whether it be in the supermarket elsewhere, you'll see some retraction. But when I say that the CPI, or the consumer prices, have gone up by 3.7%. That means versus last year, it has gone up. So it's not going up as quickly as it did, let's say, around July of 2022, where we're up maybe up 9%, but it is still going up. So that's the key thing when we talk about the economy. It is slowing down. It's not growing. Consumer prices aren't growing at a rapid pace of 9% collectively right now, but they are still going up. So that's why, yesterday's dollar isn't as strong as, or today's dollar. Yesterday's dollar is not as strong as today's dollar, pardon me. One of the key things that you can look at that was a cause for raising in consumer prices would be petroleum prices. So petroleum prices during that month of September, they were up by, I believe it was roughly about 8%. Yeah, 8.5%, pardon me. I'm not reading from a prompter. I am actually looking at my numbers by 8.5%. So with that being said, you do see that it has gone up. And if we look just for the period of September, they rose 0.4% versus in the month of August, where they rose 0.6%. But the key contributor there, as I mentioned, was petroleum prices. Again, not being at 2%, so we still have some ways to go. So there is a possibility always of the Fed, depending on what economic data comes out, of the Federal Reserve raising interest rates, or at the same point in time, before the Fed ever meets, the bond market can always raise interest rates based on the data that comes out every day during the week. That's why we've seen some of that volatility. Next, from the Bureau of Economic Analysis, we have the GDP. That's basically your gross domestic product, and that's basically all of the goods and services that are being bought and sold. So it gives you an idea of how much the economy has grown inside the United States. So that report came out on 10/26. And we are growing at an annual or a seasonal rate of 4.9%. And that's much higher. That's for the third quarter. So that's much higher than the 2.1% that we saw in the month of July. And that was buoyed by, that was speared by consumer spending, and also looking at government spending, exports, and increase in inventories by corporations. So that's your GDP, still looking robust inside the economy. Expectations. So as we close out, what are some of the expectations that we see going forward in this fourth quarter? Traders believe, because that's really how the market's moving. Institutional traders really believe that they're going to see the economy or the markets continue to grow as corporate earnings are still faring well. So they expect good November, December marketplace. We shall see. The Federal Reserve, as I mentioned, touched on interest rates. They're going to keep looking at data and adjust rates accordingly, or maybe stay flat as they have in the past two meetings. Hopefully, we all want rates to kind of stay where they are at this point in time, because they are at a 22-year high. Markets and institutions. I like to use the term "all eyes on me" from Tupac. Yeah, all eyes are on the unknown. The unknown would be, yes, economic data, but it's also on things that are, let's say, for instance, that are taking place in the Middle East right now. So that's very important. And the other thing would also be with oil prices and OPEC. So right now, Russia, as well as Saudi Arabia are continuing to cut back on their production. And when they cut back on production, that keeps prices high. So if we take a look last week, oil prices were down 5.5%. That was just based on data coming out saying that the economy is slowing. So when you have a slower economy, you generally see prices go down. When you start seeing data that's strong, then you see prices going up. So that's going to be very important as we go forward. As I mentioned, corporate earnings, interest rates, that's the key data. This being a very quick and short show, that's really all that I have for you. I hope everybody is doing well. Most importantly, I didn't mention at the beginning, but I'll mention it here at the end. Like, share, and subscribe. And if you have any questions, by all means, you can do that in the question box. Leave a question for me or contact me directly at Harare Wealth Management. You can do so, and generally, maybe I may mention your question on the next video. So with that being said, peace be unto you. Until the next time we speak, I hope you stay well. Take care.